we have any viewer mail?
No, of course not, because we don't have any viewers yet, but we would like viewer mail. So send viewer mail to doug@riskandrewardtv.org, and I'll try to answer your questions.
But now we're on iTunes, so we should have viewers.
Well, hopefully we'll have some
exciting.
viewers now. So I do have a question, which would be viewer mail, and that, of course, is how bond prices work. You know, this week the 10-year Treasury fell below 3%, which means you're loaning the government your money for 10 years, and you're only going to get 3% interest on it.
Good deal for the government.
Good deal for the government, yes. You borrow all you can at that. In fact, the mortgages, because the 10 years kind of tied to the mortgages,
All-time lows. We thought there were lows before, but now the average 30-year fixed loan is at 4.58%.
4.58% at 30 years. Yeah, if you can refi.
If you need a loan,
yeah,
get it now.
If you can get a loan. Yeah, because, boy, those are really low rates. But remember, bond prices and rates move inversely. So as rates come down, bond prices go up. And there's been several analysts that have said that the bond market is in a bubble, that this isn't sustainable. And so I'd like to show you how to think about bond prices and the impact that they would have on your portfolio if you were to jump in for the safety of, say, a 10-year Treasury bond. So if you followed the lessons, which will be posted online, you'll understand the math, but otherwise you can just follow along here. So we have number of payments, we have our interest rate, we have our present value, the amount of the payment we get every 6 months, and the future value. With the 10-year bond, the number of payments is going to be 20 because you get paid every 6 months. The interest rate currently is 3%, but since it's payments of every 6 months, it's 1.5%. The present value of your bond, a new bond, would be $1,000. The payment would be your payment every 6 months of $15, and the future value, of course, would be the $1,000 you would get back. So this is the way it would look for a new bond. But what if a year from now you want to sell your bond and interest rates have gone up?
Okay.
Okay.
What happens?
So this is what happens. The payments, instead of 20 payments, now you'll have 18 payments. The interest rate on the new bond could be twice what it is now.
Oh, easily.
Easily. So instead of 3%, it could be 6%, and 6% every 6 months is 3%. You'll still get, in the existing bond, you still get the $15 payment every 6 months.
Okay.
So that's 3%, 3% of $1,000 is $30, and that's per year, and if you get it every 6 months, it's a $15 payment. And then the future value of the bond stays at $1,000. In other words, you lent them $1,000, you get $1,000 back. So the question is, what's the value of the bond that someone else will pay a year from now for that 3% of the bond now? And without going to the math, the answer there is $793.70. So you paid $1,000 for a bond today. A year from now, interest rates have gone up, so the price of the bond has gone down by a considerable amount. $1,000 minus $793 is like what? $206.30? Is that right? $206.30. So you've lost $206.30 on a 3% investment that was totally safe in the treasuries because the interest rates went up on you. So this is why it's not that easy to say, oh, let's just buy bonds and we'll be safe.
Yeah, they're safe.
That's right. Well, they are safe in the fact that you will get your $1,000 back, but 10 years from now, if you don't hold on for those 10 years and try to sell it ahead of that and interest rates have risen, you can lose a considerable amount of money. I mean, this is $206 is a 20% loss on a 3% investment. So when you think about investing in bonds, remember that interest rates rising make bond prices fall, and if you don't hold on to the bond for the entire term of the bond, the length of the bond, then you have to sell at market prices. And obviously,
so hold on or don't buy.
Hold on or don't buy. So if you're going to invest now into treasuries at 3%, that means you really need to hold on for the next 10 years. And 10 years from now, it's 3% is going to feel like a very, very low rate of return. So, the takeaway here is that as rates rise, bond prices will fall, And if you sell before you hit maturity, you can lose principal, and in fact, you can lose considerable amount of money in bonds.